Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Shawn Cruz. He's the manager of trader services over at TD Ameritrade. We have a number of charts to get through today as we expect more volatility in the markets, and these are the levels that we're going to be watching. Shawn, it's great to have you with me as always. I mean, even let's take one day, you look at a one-day chart today, it looks like a longer-term chart with the levels of volatility and spikes that we've seen.
And that's something that I expect to play out in the markets over the coming weeks, maybe in the coming months, depending on how long it takes us to sort of get the feel that we're getting to the other side of this coronavirus outbreak. But right now, this is really just sentiment driving these large intraday moves. And we fully expect at TD Ameritrade, and I think many other shops across the street, just to see these 3, 4, 5% swings intraday one way or another. So it's definitely something that's to be on the front of traders' minds, and we don't expect that to abate anytime soon.
All right, let's take a look at our first chart here, taking a look at some levels. What do you have here?
So we're looking back and just looking over the past 3 years at just different volumes level. And so that's what all this blue is on the right side. The further to the right those bars go, that means the more volume is at that price level. 2750, 2746, right around there seems to be a very important psychological level, not only for the markets, but also if you look, this red line that sort of cuts through the middle of the blue there, that's where the bulk of the volume has been over the past 3 years. So we want to see those volume levels hold, because if we break through that 2750 level and stay below there, we don't see much support until we get down below 2700. And then after that, there's really just this sort of volume gap where you can't really expect too much liquidity to come in and get that back and forth buying and selling that can stabilize markets till you really get meaningfully below 2600. So there's definitely some levels that we want to keep in mind to watch here. 2750 I think is very important, and then after that 2700. Usually those round numbers aren't too hard to imagine. Those just sort of become psychological levels, but 2750, I think the exact number is 2746. That's a very important volume level for the S&P 500.
All right, moving along to crude, and this really has been part of the catalyst in addition to coronavirus fears that has been creating the volatility in the market.
That was sort of the 1-2 punch for the market. There was already the overhanging concerns about demand from crude oil on the back of what the coronavirus is really going to do to the global economic system, just in terms of economies having to pretty much come to a complete halt. The concern that now if you're not really booming in the economy, you don't need crude oil to make things work, keep the engines running. That was where that drop in demand concern came. Now you have Saudi Arabia and Russia seemingly in a price war, where there's the concern that now Saudi Arabia, sort of just to sort of put it to Russia, is going to try and just flood the market with oil to push that price down. And that's what drove this massive gap lower. So what we're seeing right now, and you always try and find these ranges that you can see some of these commodities trade in, it looks like 30 to 35 is going to be the range to watch here for crude oil moving forward, but that could break either way. One, if you see Russia come back and counter with their own increase in production that they're going to let out in the market, other OPEC countries decide they're going to start letting more out there. Or if you want to think of maybe a risk to the upside, Saudi Arabia and Russia finally come to some sort of an agreement and then cut back on that supply and realize, look, $30 per barrel isn't good for either of us, because Saudi Arabia is actually having to dip into their strategic reserves to get this pickup in supply that they want to do. They want to put so much out there. They don't even have that much that they're able to produce. They're actually going to have to dip into their country's strategic reserves to put that out. So I think you're going to see Saudi Arabia and Russia maybe come to some sort of agreement. And if so, you're going to see oil just rally right back up.
Yeah, it wouldn't surprise me. Nothing surprises me.
No.
And if the last 4 weeks haven't told you that, let's move along to our next chart here. It's not that we're below, 0.5% on the 10-year war at this point. It's the velocity. You don't normally see fixed income basis points move as quick as they did, certainly over the last week or two.
And I left this blue line up there because I think in a previous show that we did together here for Trade Talks, we were actually wondering, is 150 going to hold? Is 1.5% going to hold for the 10-year? And I think a lot of analysts, a lot of economists thought that 1.5% was more than likely going to remain some sort of a support level. And then we just really went right off of a cliff on the back of this just real flight to safety. First, you have the concerns of what the coronavirus is going to do to global demand. So now you have everyone trying to find safety of the U.S. Treasury. And now you've got concerns that this crash in oil prices is going to hit the energy sector, which is then going to bleed into other areas of the economy, causing sort of a second wave of funds flowing into that safety trade. And that's pushed the 10-year even lower. So at one point we were down at 0.3% for 10 years. That's an incredibly low level for someone to say, look, block your money for 10 years, I'll give you 0.3% yield on that. I think it makes sense. You're seeing some of that come undone a little bit here, and you're seeing that the 10-year Treasury rally up just a little bit. Last time I checked, we were around 0.6%, but I expect to remain somewhere 0.5% to 0.6% until we see things break either way. But I don't see a meaningful rally in these yields unless we also get a sustainable meaningful rally in equities as well.
All right, moving along to our next chart here, and we're actually taking a look at the corporate bond market. We've spoken a lot about the 10-year, the 30-year. What are you seeing in the corporate space?
I think it's important to point out here, and that is everyone says, oh, well, borrowing costs are really low, so that must be good for everyone across the board. What you're seeing over on the far right side is actually the spread, and that is what your company, if you're an investment grade, you look at the 10-year at 0.5%. If you're a company, then you've got to tack on a little bit, about 2.5% to that. So that's why as 10-year yields have gone down, which everyone thinks, oh, interest rates are low, this is great. Not if you're a corporate borrower, because those spreads are widening out. So they're saying, yeah, you know what, the 10 years going down, but you have to pay more on top of that. So borrowing costs aren't necessarily getting cheaper for some of these corporate borrowers, and that can actually be a concern for some of these more highly leveraged spaces like energy companies. I think we've already seen some energy companies come out today and have to cut their dividends off cash flow concerns. I think that's sort of the first shoe to drop, but corporate borrowers are going to need to make sure they can assure investors that they're going to have ample cash flow to be able to go out there and meet their bond payments.
That's a great way the way you explained it, because when you take a look at the corporate bond chart, and as an equity investor, why should I care what's happening in the bond space? But when you see those spreads widen, that's an indicator that the lenders might not be as confident either within the company or with the economy itself. So I think it's great that you pointed that out. Moving along to our next chart here, 30-year fixed. We touched on the 10-year, 30-year, again, seeing depressed yields.
And so for the banking sector, I think, yield spreads, widening out, that's something that may or may not affect their ability to get out there and see demand for loans. One other thing, though, that a lot of people have been focusing on is the drop in mortgage rates. Maybe that's good for housing. We've seen real estate do really well as mortgage rates have moved lower. We've even seen some of the home builders do well. For the banks, this is sort of a double-edged sword. There's a lot of refinancings. And so when you see the mortgage rates dropping, refinancings are a good little pop for banks, but banks benefit more from actual new loans being made on the back of these lower rates, not just someone coming out there and refinancing. Because what does that really mean for a bank? What that means is maybe before you were making 3% on that mortgage, now they roll it over and you're only getting 2% coming in the door based off of that mortgage. So I think that's really for banks. It can actually really hurt their net interest margins. They would rather see the pickup in actual new loans. That's a lot more accretive for some of these banks than just simple refinancings. But mortgage rates definitely should help the housing sector. We'll find out how much that demand was pulled forward into January. If you think about it, we had an unseasonably warm January, so we had really strong construction spending. We had some pretty good housing numbers coming out in January, and the question is, are we robbing Peter to pay Paul? Is that instead of that activity coming out in June, it all got pulled into January, which means when we get into that spring busy season, some of those buyers we expect to show up were actually already there in January. But I think this might be interesting to see if it could maybe pull some of those marginal new home borrowers into the market and take out a mortgage.
And you might also see depressed demand because of what's happening with the coronavirus. People might not start to get paid. You might see furloughs and so forth. So it's an interesting point that you make about January.
There's never any one thing. Things never move in
Right.
direction. There's always this back and forth. The dropping mortgage rates should push demand up, but also economic concerns should sort of counteract some of that. So it'll be interesting to see where exactly we fall.
All right, let's wrap it up here with our last chart, 10-day historical volatility. Why are you taking a look at that number?
So we're really just trying to get a feel for where's the uncertainty, where's the fear playing out, and what we've seen over the past 10 days. Because we've seen, and I think in the past 10 days, you've seen the market have to absorb a lot of new information. There's been this pretty big escalation and spread in the coronavirus. Then you've also had OPEC come out and announce that they've got a little bit of infighting going between them and Russia, and that's put a lot of pressure on the energy sector. But I think this sort of plays out in the last two charts we talked about, where you're seeing energy incredibly volatile, 119%, which you think, how can it be over 100? It has just been so volatile, these massive intraday swings, pushing that historical volatility number up. And then the financial sector at 76%, also right there, and that's on concerns around loan demand, what the net interest margins are going to mean for them with these interest rates coming down. So we've seen a lot of that focused in energy and financials, and then some of the other cyclical type sectors also. Not hard to imagine that you're going to see industrials and materials start to get hit. if you feel the economy is going to slow down, you're not going to be putting as many factory orders, and then by extension, those factories aren't going to need as many raw materials because they're also don't need inputs if there's not going to be any need for output. So I think this kind of shows where the volatility, overall S&P 500, 60%, but these cyclicals and these sectors that are really exposed to just general economic activity have definitely been the most volatile we've seen over the past.
That's a great little chart. You can get a lot. You can discern a lot out of this chart for sure.
You sort of see, where the market's been, and that the staples. I actually was surprised to see utilities as volatile as they are, but we have seen a lot of moves in interest rates, a lot of moves in commodity prices, which could be driving volatility there. But definitely makes sense. We're seeing energy and financials be volatile, and I expect those to be at the forefront of volatility over the coming weeks as we just get new information, new headlines day to day.
All right, Shawn, great stuff as always. Thanks for joining me.
Thank you.
And thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.